Good afternoon and welcome to BizTech Asian Midday Market Watch. I'm Samantha Voon and my co-host Brian Fernandez. Let's start by taking a look at the market movements right now. Brian, over to you.
Now, thank you very much, Sam. Now, we'll start with the US. Now, US stock index futures declined during Asian trading hours as uncertainty over the upcoming US presidential elections continued to weigh in on sentiment. Now, Asian stocks were also impacted by the increased risk aversion following President Joe Biden's withdrawal from the race and his endorsement of Vice President Kamala Harris as the Democratic presidential nominee. Now, Republican nominee Donald Trump has stated that Harris would be easier to defeat. Now, he has been leading in polls conducted by CBS and X, although these were taken before Biden's withdrawal. Now, most Asian stocks saw gains as major technology stocks basically rose on overnight trading, bounced back from a recent slump, I beg your pardon, although Chinese markets lagged due to persistent negative sentiment towards the country. Now, regional markets followed a strong overnight session on Wall Street, primarily driven by a rebound in major tech shares. Now, investors were focused on the upcoming quarterly results coming from the likes of Alphabet and Tesla, which are set to be released today. Now, over in China, the Shanghai Composite Index dropped 0.59%, while the tech-heavy Hang Seng declined by 0.17%. Now, sentiment from China remains weak despite a surprise interest rate cut by the People's Bank of China yesterday. Now, with analysts suggesting that the cut was far too small to have a significant impact. Now, the third plenum of the Chinese Communist Party disappointed investors by providing few details on plans for additional stimulus. Now, concerns over a potential Trump presidency, given his hardline stance against China and the possibility of more trade restrictions, further weighed in on Chinese markets. Now, with that, Sam, over to you for the rest of the updates.
Thank you, Brian. So over in Australia, the ASX 200 increased by 0.59%, supported by gains in major banks and mining stocks, as we see a continued rotation into economically sensitive sectors. For India, the Nifty 50 index indicated a slight positive opening earlier this morning, keeping it at record highs as there are optimism about the Indian economy and also a weak rupee. We also have upcoming presentations of the India Budget 2024 today, and that could introduce some volatility into the local markets. Over in Singapore, the STI is up 0.49%. In Malaysia, the KLCI is up 0.52%. In Japan, the Nikkei 225 index rose by 0.08%, and this is driven by strength in the tech stocks as regional semiconductor sectors followed the rebound of the lead AI giant NVIDIA. Over in Korea, Kospi increased by 0.52%, and this is supported by data showing a slight rise in factory inflation for June. Overall, although tech-savvy indexes experienced some relief today, but they are still recovering from the steep declines that happened over the past weeks. Also factoring in that expectations of the rate cuts is still heavy on the table, and this is leading investors to shift towards sectors more likely to benefit from the economic recovery. So that's all I have for today's market update. Brian, over to you.
Yeah, thanks, Sam. Now, to give us more insights into markets, we have Tim Waterer joining us. He's the Chief Market Analyst at KCM Trade, coming to us out of Sydney. Tim, it's always great to have you on the show.
Hi, Brian. Hi, Sam. Great to be here.
Now, Tim, with all the things that are happening in the US political scene, how has this impacted market sentiments on equities, in particular in the region?
Yeah, there's certainly been a lot happening. It's been a busy week and a half in financial markets. And I think what we're seeing is basically traders just trying to position ahead of those November elections now. A few things investors are considering are, I guess, what each party brings to the table. So if we cast our minds back to the first Trump term. He sort of ran on that, tax cuts, deregulation, that sort of, suited Wall Street. So we've already had a preview of what we could see from a second Trump term, but that comes with the added risk of escalated trade wars. But I guess just balancing that out, I mean, if we look at, I guess, what's happened under the Biden administration with China, there has been also a ratcheting up of tariffs, 100% on EVs, for example, aluminium, steel. So it hasn't been smooth sailing under Biden either. So I think that's what traders are really trying to gauge at the moment, is where they should be positioning. And I think that's why we're seeing a little bit of reluctance or hesitation around some of these stocks which have done well so far this year, the AI semiconductor sector. That's a bit of a hot spot, I guess, leading up to these elections.
Mhm. So, Tim, what about the FX scene? What has changed, and what can we expect from moving up forward?
Yeah, so in terms of the FX market, I mean, if we look at what's happened over the past couple of weeks, we had the softer payrolls figures in the US, softer inflation prints, and that sent the US dollar index lower. Last week, it was hovering around that 103.65 level. Since then, though, the negative data, if you like, has dried up, and the dollar's moved back above that 104 level. And I think that's as a result of traders just realizing that while we do expect the Fed will be cutting in 2024, they won't be on their lonesome in that regard. So with the likes of the ECB already having cut, the Bank of England, they're looking prime for perhaps monetary loosening in coming months as well. So I think it's right now investors are seeing that, okay, while we could see a reduction in the dollar's yield advantage, it'll still have probably a significant yield advantage as we approach year end, particularly when you look at macro data in the US, still stronger than what we're seeing in the Eurozone at the moment. So I think, just forecasting ahead, traders are thinking maybe the Fed won't be quite as aggressive on rate cuts as some other regions, ECB, BOE, for example. And that's why the dollar hasn't lost a great deal of value, despite the September rate cut almost 100% priced in at this point.
Mm-hmm.
Now,
So before
Tim,
you move on, sorry.
Go ahead.
Before you move on to the next question, Tim, how about RBA? Over in Australia, it doesn't seem to be having the same stance, right? For the
That's
RBA.
right. So Australia, is in a bit of almost a unique situation amongst the sort of, I guess, major central banks at the moment, where CPI has been moving higher in recent months. The jobs figures we saw for Australia released last week, they were almost double what was expected. So there is a growing expectation that we could in fact see the next move from the RBA being a hike rather than a cut. So it's sort of a bit of a split decision at the moment as to what they may do come August and towards the end of the year, but certainly a rate hike is on the table at this point. So that's, I guess, a bit of a downer for the local stock market at the moment. Seeing other regions around the globe moving, I guess, closer to rate cuts, whereas we might wait a bit longer here. Certainly looking like into 2025 perhaps before we do see a reduction in that cash rate from the RBA. So interest rates hot topic here at the moment, and we're keeping our eye out for very much a possible hike in coming months from the RBA.
So Tim, moving on from that, so obviously the Australian economy is running hotter than we expected, and where is that coming from, and how is that impacting commodities, particularly gold?
So depending where you look in the Australian market, certainly a number of key indicators are running hot. So that jobs market, I would point to that first and foremost. That's very tight still. So unemployment rate still hovering around that 4% mark, but previous month added 40,000 jobs. We're expecting about 20. So I think there is still an underestimation of how tight that jobs market is. Inflation figures have been moving higher. I mean, if we look at what the source of that has been, a lot of it comes down to the housing market. So rental costs have been increasing, cost of living, electricity bills, for example, that's also a hot topic here at the moment. So we have had also a lot of population growth in Australia, a lot of immigration happening. So that's added to population levels, and that's also adding to keeping the jobs market tight and also that housing market as well. So that's what's, I guess, causing some grey hairs for the RBA officials at the moment, is watching that CPI ticking higher. Now, they're still projecting we will get down to that 2 to 3% target, but it could be sort of, back end of 2025 at this point. And that's why they're having to stay hawkish on the rate front.
Now, Tim, then I want to zoom in again back on gold specifically from an investor standpoint. It's regained its luster. Where are you seeing gold as well as some of the other commodities that are doing well right now hitting?
Yeah, so gold obviously had a record-breaking week last week for the spot price. So once again, gold moved higher as US Treasury yields and the US dollar moved lower. So lower opportunity cost for holding gold. It went up to that new record high price. So we've seen it drift a bit lower this week, tied in with that dollar strength that we've seen. But having said that, I still think the outlook is bullish for the gold price based on that expectation of a lower interest rate environment. So I do expect we probably will see that $2,500 level hit in the short to medium term. So I think that's still a very much a viable target. One thing I would say is that we saw certainly a very rampant run in gold for the first half of the year. It may not be so quick in the second half. And I think that's because we have seen central bank demand from China sort of putting the brakes on a little bit in the past couple of months. So that really underpinned the price in the first half. Central banks such as China and India diversifying away from the dollar, adding gold reserves. China, they've just kind of paused on that at the moment, not sure when they'll return. But if there is, I guess, that absence of Chinese central bank buying, that could slow the gains for gold in the second half of the year. But as I said, I still think the outlook is quite constructive for gold based on where it is now versus US rates at 5.5%. Certainly a case could be made that gold will be higher from here once US interest rates drift below that 5% level.
Tim, how about oil? Can you comment about oil as well?
Yeah, so oil, it has been having a good month overall, past couple of months really. We've seen it move a little bit higher in the past few sessions though. So some of that is based on some talk of a potential ceasefire in Gaza. So that saw some of the risk premium removed from that crude oil price. However, I still think there's an upside bias to oil. So I'd be a little bit wary of shorting it at these levels based on the fact that we are sort of in the midst of hurricane season in the US off the Gulf Coast. So there's always that chance we could get supply disruptions. And of course, while there was talk of a ceasefire, we still have two, hot war zones at the moment in oil producing regions. So that's why I'd be wary of going short at these levels. I still, favour upside from here. And I think we could be still looking at, say, the Brent contract, for example, moving back towards that sort of $86 a barrel level in coming months. Depends on how the Northern Hemisphere summer season goes, and we may get a bit of a look at that this week with the US stockpiles figures. So if there's a larger than expected drawdown there, that would tell us that demand's pretty healthy at the moment for oil. And the other thing about oil is, of course, generally works better in a lower interest rate environment. Lower interest rates, generally helps consumption of oil. So that's another thing to factor as we head towards year end. So yeah, oil down this week, but overall it's been trending higher over the past month. And yeah, I still think could creep higher from here, unless we did see a big change of circumstances, either in the Middle East or basically a very tame hurricane season in the US.
Thank you so much, Tim. Thanks for coming on to the show today.
My pleasure. Thanks very much.
We'll be speaking to Tim Watera, Chief Market Analyst at KCM Trade. This has been BizTech Asia Midday Market Watch. Be sure to keep informed on the latest market updates weekdays at 1 p.m. I'm Samantha Voon.
And I'm Brian Fernandez.
And this video and podcast will be on our website, www.biztech.asia, and our social media platforms. It will also be on our syndication partners' TV stations, radio stations, and website. Remember to like and subscribe. Thanks for tuning in.